You know, we often take the real basics for granted. The simple act of just walking into a bank, showing your ID, and opening an account.
It feels like a non-event for most of us.
Exactly, a total non-event. But for millions of people worldwide, I'm talking about immigrants, refugees, the undocumented, that simple act, it's blocked.
And completely blocked. And by these huge systemic and sometimes really dangerous barriers.
And that barrier is this fascinating intersection of global finance, human rights, and even security policy.
It really is. Today, we're diving deep into that exact tension point.
Yeah.
How do global financial regulators and banks manage to promote financial inclusion while also upholding these incredibly stringent anti-money laundering standards, or AML?
So our mission today is to really pull out the key strategies. We're talking about surprising global examples, alternative forms of ID, flexible products, all the things that are being used right now to bridge this gap.
And we're using sources from regulatory giants like the Financial Action Task Force, we'll just call them FATF for short, and also key consumer advocacy groups.
Okay, so where do we even begin? I think we have to start with the atmosphere these communities are facing.
I agree. You have to start with the fear. Advocacy groups are pointing out that in recent years, some banks have started introducing these really intrusive questions about citizenship status.
Even banks that historically welcomed immigrant customers.
Exactly. So you get this immediate fear factor. When an institution that's supposed to represent stability starts asking questions that feel directly linked to immigration enforcement.
It creates instant mistrust. You'd be understandably wary of engaging with them, fearing deportation or just losing everything you've saved.
And that lack of trust has a direct consequence. It pushes all this essential economic activity
underground
completely into unregulated cash-based markets. And that creates real, tangible security risks for people.
Let's talk about that for a second, the high cost of this exclusion. Because it's not abstract, it's personal and, frankly, terrifying.
It is. When you can't use a bank, you're pretty much forced to carry large amounts of cash.
Which is basically an invitation for crime.
A huge invitation.
Lisa.
I see these devastating examples all over the world. I mean, think about the Chinese community in Paris who are being heavily targeted for muggings.
And why them specifically?
Because of the perception. They were seen as carrying large sums of cash, and critically, they were believed to be unlikely to report the crimes.
Out of fear of immigration detection.
Precisely. That story alone just shows how high the stakes really are. This isn't about inconvenience, it's about survival.
And the economic vulnerability just compounds that physical risk, doesn't it?
Oh, absolutely. If a crisis hits, say, you need to pay bond for a detained family member, or there's a medical emergency, you're forced to turn to predatory products.
Or outright fraudsters.
Or outright fraudsters who are just preying on that vulnerability.
So if we pull back and look at this from a systemic level, what's the regulatory view on this? I mean, does the formal system actually care if a whole segment of the population is excluded?
It absolutely does, and this is key. FATF recognizes that financial exclusion is in itself an AML risk factor.
Okay, so their own risk.
Exactly, their own risk. When the bulk of transactions in a community are driven into unregulated, cash-based channels, it completely undermines the integrity of the formal financial system. It makes it exponentially harder to track illicit flows, like money laundering or terrorist financing.
Which brings us straight into the biggest tension in the industry, this practice that gets talked about all the time, de-risking.
Right.
Banks are trying to prevent money laundering, but then they get criticized for denying services. So what does de-risking actually look like from the institution side?
So de-risking is when a financial institution, an FI, refuses or terminates or severely restricts services to entire categories of customers.
Not just one person they think is risky, but a whole group.
A whole group. It could be refugees, specific ethnic groups, or even legitimate businesses like money transfer services, which, immigrant communities rely on for remittances. They do it to avoid perceived regulatory risk, rather than managing that risk case by case.
It sounds a bit like the banks are throwing the baby out with the bathwater just to protect themselves from potentially massive AML fines.
Well, that's the pragmatic defense you'll hear, yes.
I mean, it's a rational business decision if the cost of one AML failure outweighs all the profit from that client segment, right?
It might seem rational on a spreadsheet, but the global regulatory stance is actually very clear on this. This kind of wholesale de-risking is contrary to the entire philosophy of the risk-based approach, the RBA, that organizations like FATF promote.
So the regulators are actually against it.
They are. International bodies like the G20, the IMF,
Yeah.
bank, they all see financial inclusion and AML goals as mutually supportive, not antagonistic.
That's a crucial point. More people using regulated services actually strengthens the system.
It strengthens financial integrity, exactly.
Okay, so if the philosophy is this risk-based approach, the RBA, let's get into the practical application. And when we talk practical, nothing is more fundamental than the ID itself.
There's the main stumbling block globally. The data shows that 27% of unserved adults cite the lack of necessary ID docs as the major barrier to opening an account.
Wow, more than a quarter.
And it disproportionately hits women in low-income countries. 44% of women there lack formal ID compared to just 28% of men.
And focusing on the U.S. for a moment, there's this common misconception that banks have to exclude immigrants if they don't have, say, a green card or a social security number.
And the sources are very, very clear on this point. There is no federal or state requirement in the U.S. that says banks must exclude customers based on their immigration status.
So they have flexibility.
A lot of flexibility. In fact, if a bank creates a blanket policy of excluding all non-green card holders, it actually risks violating civil rights laws, like the Civil Rights Act or the California Unruh Act.
Which prohibit discrimination based on citizenship status.
Okay. So that legal clarity provides significant and necessary room to maneuver.
So how do banks manage that risk operationally without just saying no? This is where the RBA's main tool comes in, right? Simplified Customer Due Diligence, or SDD.
Exactly. And what's so fascinating here is that SDD does not mean you just skip due diligence.
It's not a free pass.
Not at all. Think of it like a provisional driver's license. We can't give you the full license yet because we don't have every piece of documentation, but we can give you a restricted license.
One that lets you manage basic tasks, like driving only during daylight hours.
Exactly. Or, in the financial world, having an account with a limited balance. It just means applying less intensive, less formal measures in scenarios that are assessed as lower risk.
So the core idea is you give them a starter financial license, not an immediate full access pass. And the best practical way to do that is through tiered accounts.
That is the proven mitigation strategy, and we see incredible examples of it globally.
Like where?
Well, China, for instance, classifies accounts. A Type 1 account is full function. Type 2 allows limited transfers and payments. And Type 3, which you can often open remotely, has a strict volume cap and can't handle cash deposits or withdrawals.
So the restrictions themselves mitigate the risk that comes from maybe less robust ID verification.
Perfectly put. Mexico has a similar system. They classify accounts by the level of money laundering risk. A low-risk level 1 account can be opened without a face-to-face meeting, but it's capped on its balance, and importantly, there's no cross-border activity allowed.
And this tiered approach, it can even work for customers who are assessed as higher risk.
Yes. Singaporean banks offer something called limited-purpose banking accounts for individuals like ex-offenders.
What does that mean, limited purpose?
Means it meets their basic needs. They can receive a salary, they can pay their bills, but the account is subject to enhanced monitoring and restrictions. For example, it might only be able to receive funds from a specified pre-approved source, like their employer.
So you're truly managing risk through control, not avoiding it through exclusion.
That's the RBA in action.
And I saw that the World Bank even offers a tool to help regulators figure this out, right?
They do. It's called the Financial Inclusion Product Risk Assessment Module, or FIRM.
Firm.
It gives regulators a systematic checklist to assess if their current rules are creating unnecessary roadblocks. Countries like Bangladesh, Malawi, Tanzania, they're using this tool to see if specific products, like microcredit or dedicated farmer accounts, can confidently qualify as low risk.
And therefore justify using the simplified due diligence, the SDD.
Exactly.
Okay, let's move from the policy mechanics to what's happening on the ground. Let's talk about the actual ID documents banks can accept, particularly in the U.S. What are the alternatives to a Social Security number?
The main recommendation is to just broaden the aperture of what's considered an acceptable document. A critical one is the ITIN, the Individual Taxpayer Identification Number.
Which the IRS issues to non-citizens for tax purposes?
Right. Banks should also be accepting government-issued driver's licenses, including foreign ones, and consular IDs.
And we can't forget about local solutions, like the municipal IDs. New York City and San Francisco have them. They let someone prove their identity and where they live, even if they don't have federal documents.
But the most standout examples, for me, are the ones that show real flexibility, leveraging a kind of social collateral.
What do you mean by that?
Take Fiji. Financial institutions there will allow someone to use a birth certificate plus a confirmation letter from a suitable referee.
A suitable referee. That's a powerful cultural idea we don't really see in Western banking. Who qualifies?
It's someone the institution trusts. It could be a village headman, a school principal, a religious leader. They provide a letter verifying the person's name and address.
And how do they control the risk of fraud?
The Financial Intelligence Unit advises banks to specifically monitor accounts that are opened using a referee certificate. So they control the risk through monitoring, not denial.
That's just incredibly clever. There are also those emergency measures like in Turkey after the 2023 earthquake.
A great example. Victims who lost their physical IDs could still be identified by banks by cross-checking at least 4 pieces of personal information check, mother's name, birth date, etc., against a national database.
And what about for refugees and asylum seekers who often have very provisional documents?
The approach is tailored. In Malawi, for example, banks set up branches inside the Dzaleka refugee camp.
They went to where the customers are.
Exactly. And they accept fact sheets or ID cards issued by the UN High Commissioner for Refugees. And for proof of residence, they'll even accept a map showing where the person lives inside the camp.
These examples really show how FIs can become trusted partners when they actually engage with the community's reality.
They really do.
So finally, let's look at the actual products, beyond just a standard checking account, that can promote real financial health for this population.
A crucial one is the Second Chance account. It's designed for customers who've been reported to consumer reporting agencies, maybe because they racked up high fees or had an account closed involuntarily. It lets them re-enter the system,
So it gives them a pathway back.
a clear pathway, sometimes with the option to upgrade to a traditional account after, say, 6 months to a year of positive behavior.
And then there's credit. Access to affordable credit is paramount, especially for these big life events like immigration fees or emergencies.
Precisely. The Self-Help Federal Credit Union has a fantastic model called the Fresh Start Loan.
How does that work?
The money the client borrows is put directly into their savings account. As they pay off the loan, they build a credit history. A study from 2016 showed that 70% of borrowers actually increased their credit score after taking out one of these loans.
That's amazing. It's a mechanism for self-sufficiency that's built right into the product itself.
It's a powerful tool.
And what about getting access to government assistance?
That's another key area. Banks should make it simple for clients to receive safety net cash assistance, like California's KPI program, electronically.
Right, direct deposit.
Using electronic deposits avoids those high transaction fees you get from check cashing places or expensive prepaid cards. It increases privacy and gives people better options for managing their money.
So this deep dive has really shown that financial institutions have the legal flexibility and the clear regulatory encouragement to move beyond de-risking.
They absolutely do. They can become true partners for immigrant communities by adopting this flexible RBA framework and simplified due diligence.
And it seems like it's working to a degree.
It is. It's a success story in progress. I mean, access to formal financial services globally grew by a massive 50% between 2011 and 2021.
Yeah.
We know how to open accounts for these populations now.
So I sense there's a but coming.
There is. Here's the challenge that remains. Simply opening an account is not the end goal.
Okay, so what's the next frontier we need to be looking at?
The data shows that usage often lags way behind access. For example, by the end of 2023, only 26% of new mobile money accounts in developing economies were actually active on a monthly basis.
So people are opening them but not really using them.
Exactly.
Yeah.
So the challenge isn't just giving them the key to the account anymore. It's more like giving them the blueprint for the house.
I see.
We have to make sure the tools we build next are affordable and appropriate and useful enough that a newly banked refugee or immigrant actually trusts and relies on them. That's how you turn access into long-term financial security. That's sustained active engagement. That's the new mission.